Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Wood.
All right. Happy Monday to you.
Yes, sir. Yes, sir. Happy Monday. And my goodness, we've only got one more of these before it's election time.
That's right. That's right. 8 more days before the election. So
yeah, well, about 8, about 8 more days. Yeah, that's right. I think that's
about
right.
8 more days.
So, yeah. I'm not good at math sometimes. So yeah, golly, man. I mean, I know we talked about it last week about the election putting everybody in not wanting to make decisions, right? Indecision is everywhere. So, but then we were talking last week about refinancing and what's going on with that. And I thought refinancing was way up. And now you're telling me last week that refinancing is back down.
No,
so what the heck is going on?
Refinancing is up. Refinancing is definitely up because rates are down, but it started to slow down a little bit more after the Fed cut. So because
that doesn't make any sense. That doesn't make any sense. The Fed cuts rates, and I get it that they're not directly connected, right? But they're indirectly connected, or at least I thought they were. So the Fed drops the rate, and they go down a little bit, and then they just shoot up, right? So what the heck?
They went down one day. It wasn't even a full day, actually. It wasn't even a full day. So you have to understand the dynamic behind it, because I don't think most people do. And when I, on my radio shows was telling people that there's a good chance that interest rates could go up if the Fed cuts the Fed rate, and everybody was looking at me like I was some kind of a moron. So, but that's okay. The moron has now come out, and he is no longer a moron. He is now actually a Nostradamus. How about that? So
there you go.
Here's the reality. You have to understand the dynamics. So why does the Fed bother to cut a Fed rate or increase a Fed rate? Well, if they're going to cut it, the design is to stimulate the economy. The economy's slowing down. And the economy's slowing down because inflation was slowing down. Didn't stop, but it's slowing down. So they stimulate the economy to get the economy up and moving again. Well, what happens when you stimulate the economy is that tends to stimulate the stock market, because if the economy is going better, the stock market's doing better. And if institutional money, meaning big money, not yours and my stock that we have in Google, but institutional money that moves from bonds to equities being stocks, right? So bonds are their safe haven. When the market is unstable, institutional money goes to bonds. They don't make any money, but they don't lose their money.
Right.
When the market is more favorable or stimulated, they move that money into equities so that it moves and they make money with it. So when the Fed dropped the Fed rate, that stimulated the stock market. Money comes out of the bonds and into the stock market, drop the bond market. So when the bond market goes down, interest rates go up, because bonds, interest rates for mortgages are tied to the 10 and the 30-year bond. So when that happened, it deflated it. It literally just took the air right out of it, and interest rates for mortgages tended to go up. Interest rates for mortgages today are 250 basis points higher on the discount point than they were the day that the Fed dropped the Fed rate.
Yeah,
so they're
that's
much
crazy.
worse.
So the actual interest rate made a change slightly, but how much it costs to buy that interest rate went up.
That's right. So for the same interest rate, let's just say that the average interest rate was 6.25 the day the Fed dropped the Fed rate. And at 6.25, let's say that cost you 1 point. It would cost you 3.5 points today.
Right. Because you're buying the interest
for
rate
the same rate. So people don't go the same rate because nobody's going to pay 3.5 points. You couldn't
so then
even
you pay the higher
that if
rate
you wanted to. So you up the interest rate. So now the interest rate is going up, back up into the even into the high 6s in some cases.
And that's what creates your spread on interest rate versus APR, right? Because of those points that you pay up front. Right?
Well, points are one aspect of it.
Most
of the closing costs are all incorporated in your APR.
So let me so counter to that though, when the Fed had interest rates set at 0 to 0.5% for the last decade up until 2 years ago, right? I mean, they were set to virtually zero. Rates were 2%, 3%.
That's right.
Right. And so why is it different now when they drop rates that it doesn't do what we want it to do? It does the opposite of that.
Well, we're not at zero, and we also are just coming off of inflation. And if the bond market is suffering, so during COVID, we had artificial stimulation because the Fed was literally buying mortgage-backed securities. So you have to remember, we have to rely on the private sector out there to purchase mortgage-backed securities. But when the private sector says, I ain't purchasing no mortgage-backed security at 1%, I'm not making any money on that. So it was artificially. So the government stepped in and was buying the mortgage-backed securities to keep the rates low. But when they said, hey, listen, we're going to go ahead and stop buying mortgage-backed securities, and they did, they started to wean themselves off by 10 million, 20 million, $100 million in an allotment. And then interest rates started to go up because the private sector wasn't willing to buy them at that cheap rate. So they're more interested in buying them when rates are higher.
So that's interesting. So I've always thought around the Fed rate and the bonds, and as you've talked about, but then we throw in another factor of appetite for that yield, right? And if it's 1%, I certainly don't want to buy that yield. It's a crap.
Yeah, you're not going to loan money at that. Who is?
Right. And so then the government is essentially forced to, or let the spoils happen, right? And they certainly didn't want that to happen. So they went ahead and sucked it up and bought that lousy debt.
Right. Well, and now
it's not bad debt; it's just low yield debt.
That's right. That's right.
Super low yield. So now
the other thing that's happened.
So now the Fed's out of that business. They're not buying as much mortgage-backed securities as
that's
were,
correct.
Right?
They've cut back on mortgage-backed securities. I don't even know if they're buying any right now.
They may be buying
zero. And if the private sector doesn't see the yield on it, then they're not going to buy it either. So then it just compounds.
Right. So they'll buy it, but they'll buy it at a discount. And that's where the cost comes.
So now the money will be made on the upswing. So when we start to see things turn around, I think it'll stimulate the bond market, and the bond market will create a much better yield for people. So there will be a day for that. And it's around the corner. Now, the election could have something to do with that as well. So we don't know which direction that's going to go in, but it will go in one direction.
Well, we know one thing. We know one thing for certain, right? And that is we will have a new president.
We won't have the same president.
No matter what. And so, whoever you like, whoever you voted for, you're going to get one or the other. And, we're all going to have to deal with the consequences of those actions, right? Whether you like them or you don't, whether you like the particular thing. And I don't know, man. I'm glad I'm in this business, but sometimes I feel like
it's a ride in a stagecoach. That's for sure. I mean, it's a bumpy ride. It always has been. It always will be. I think that, this business is feast or famine. You're either doing really well or you're not doing as well. And it's very cyclical, and it will come back. And the fact of the matter is that housing prices will not drop. They're not going to go down. And even when they go down, it's very, very seldom. If you look at an 80-year chart, we've only had 5 years where we really are significantly dropped in value, maybe 6 at tops. But actually, out of that 6, 2 of them were really zero. In other words, real estate didn't grow. But if you look at after times like this, so this is actually your buying opportunity, because if you look at charts, when we come out of these situations is when we'll start to see 13, 15, 20% in growth in real estate. So you have to be ready to go. You can't wait for that time. Now is your signal. Everybody says buy low, sell high, buy low, sell high. Guess what you got? You got low real estate prices right now. They're not going to go lower. And how much have we seen in growth right now, year over year, from this time last year?
5%. 5% from last year. 5%.
3% is an average, 5% in a crappy year. Okay.
In a crappy
So
year.
you
Yeah.
have to look at that.
And a lot of that is because of the golden handcuffs, right? A lot of people are just, I don't say they're stuck, but they're unwilling to sell because they have a great rate. They have a, 2.5%, 3% rate that they got back in 2020 or 2021. And, they want to sell, they need to sell, they feel like selling, but
Yep.
they're not going to because they just I wouldn't either. I
Well,
wouldn't
it
either
really,
unless I had
there's
to.
always a need. And here's the thing. If you didn't have to move, you probably wouldn't move. But some people, their families are growing, their job was relocated, the house isn't big enough, they were renting and they want to quit renting. I mean, you can't complain about a 6.5% interest rate when you're paying rent. Even if you get if you have low rent, 100% of that is going to the landlord. If you make a mortgage payment, every mortgage payment is going to reduce your principal, every single payment. And you're gaining equity. On a $450,000 house, you're gaining $23,000 per year at the pace we're at now. When interest rates drop to 5%, you can expect that pace is going to go way up.
Absolutely. Absolutely. I still, the only regret I have in real estate is selling some that I bought and not buying
100% would agree with that. The two major mistakes, not buying enough and selling too many.
That's right. Bruce, we have got to go, but next week is our election eve event. So
get out there and vote,
let's prep
you guys.
for that.
Listen, one way or another, somebody's going to get in there. Think carefully about who you're voting for. There's a lot of misinformation out there from both sides. Just be cautious.
Absolutely.
Look at what's going to stimulate the economy, because at the end of the day, whoever really has the right plan to stimulate the economy is going to make your life better. Your life is always better when the economy has been stimulated and there's more people back to work. If you look at the past 4 years, was it better for you or was it worse? If it was better prior to Biden, then you have to take that in consideration. If it wasn't, then take that into consideration. But I think for many of us, we're looking at a better lifestyle moving ahead, because I can tell you one thing right now. Every business out there, with the exception of food and medical, has a relationship to real estate. Cars, plumbers, electricians, parts. When real estate is doing well, everything is doing well. When we're not doing as well, most people are hurting.
That's a good point. It's a good point. All right, man. Well, I will see you next
Tune
week
in
on
to the
Election
Loner
Eve.
Ranger radio show Saturdays on WDBO 580 AM at noon, and Sundays at 11 o'clock, and on 102.5 The Bone out of Tampa, 11 o'clock on Saturdays. Tune in and watch the Loner Ranger radio show. And we oftentimes have my friend Tom McNamara as a guest host on the show. So we look forward to having you join us again.